Step into the super crowd, where dreams take flight. Learn to invest like a pro, make your future bright. Impact investing, changing the game. Crowdfund the world, it'll never be the same. SuperCrowdHour, come join the ride. Change the world with us, we're on your side. SuperCrowdHour, come join the ride. Change the world with us, we're on your side.
Welcome, everyone, to the Super Crowd Hour. Today, we're going to be talking about 6 different investment types that you need to understand to be able to invest like a pro. I'm your host here, Devin Thorpe, and I am just so excited. We've got some great content for you. I want to just take a minute as we begin to acknowledge a couple of things here. So let me just, I'm going to share some slides here, but I want to thank Chandan Saha. He's our producer, just does a phenomenal job of working with me on all of our work here at the Super Crowd, but we're especially grateful for his work today. So I acknowledge and thank him. I also need to note that we're going to talk about money today, and I am not your financial advisor. I'm providing some educational information. I will not recommend any specific investments to you today. You shouldn't conclude that I have. And so be careful. If you need financial advice, you can certainly reach out and I can give you the names of some great financial advisors. You know, we're trying to build a movement here, and I want to invite you to join the movement. And one of the most fun ways to join the movement is to join the Impact Cherub Club. This is a regular a club that meets about once a month on the 3rd Tuesday of each month at 1 Eastern. Visit impactcherub.com to learn more. But it's a group of small angel investors, ordinary people who invest in startup businesses and small businesses directly. And we have a lot of fun doing it. So I invite you to join us. I hope you'll consider that. We also have a mastermind group that we've established for helping entrepreneurs, small business owners who are raising capital from the crowd to share insights and information to help make the journey of raising capital from the crowd a bit easier and more productive. You know, I occasionally hear from frantically busy CEOs that are trying to raise money from the crowd that they don't have time for the mastermind group. You know, here's the reality. If you're trying to raise money from the crowd, you don't have the time not to participate in the mastermind, where you can get some leverage, some ideas on how to be more efficient and effective with your capital raising. Visit 4sc.fund/MM as in mastermind to learn more. That's 4sc.fund/MM. You know, if you're not already following the Super Crowd, I encourage you to sign up for our Superpowers for Good newsletter. Visit superpowersforgood.com. That's superpowers4good.com to sign up for our newsletter. You can also see our past episodes of our twice weekly show, and you'll get those in your inbox. You know, a new newsletter 6 or 7 days a week. Tremendous amounts of informative, helpful content. You don't want to miss this. So I invite you to participate. With that, I think we're going to take a quick. I'm going to play a little an homage to our sponsors. I want to recognize that our sponsors, especially Digital Niche Agency, that is our max impact sponsor. We couldn't do this work without their support, and want you to know and appreciate them. So let me roll this quick introduction.
Digital Niche Agency is the top investor acquisition agency. DNA has helped founders raise over 9 figures via regulated investment crowdfunding with a 3-pronged strategy using digital advertising, content marketing, and strategic outreach. You can't argue with success, but you can learn from it. Put the best to work for you. Book a call today.
Purpose Rounds, transforming customers and community into owners and advocates. Visit purposerounds.com to learn more.
Halyard Compliance has a proven history of customizing compliance programs that are tailored to your unique business model. Visit halyardcompliance.com.
We are grateful for financial support from Funding Hope, the American Independent Business Alliance, Ridgecrest Herbals, Move the Needle with Rob Kaplan, and Rotary International.
We appreciate our co-hosts.
Prepare to be inspired by Devin Thorpe, a powerhouse in impact journalism and social good advocacy. This best-selling author hosts the acclaimed Superpowers for Good TV show featuring global changemakers like Bill Gates. With a readership of over 2 million, his 500-plus Forbes articles have shaped the dialogue on purpose-driven leadership and crowdfunding innovation. A sought-after speaker from the United Nations to Johnson & Johnson, Devin's unique blend of expertise as a former CFO and investment banker fuels his captivating presentations. Please welcome the dynamic and visionary Devin Thorpe, here to empower us all to harness our superpowers for good.
Well, it's fun to be with you here today, and I really am excited to share an important message with you. I want to share, to start, a story of my youth. 1976, this dam in southern Idaho called the Teton Dam failed the first time the reservoir was filled. And there was a town downstream called Rexburg of about 10 or 12,000 people at the time. And that town was devastated by this flood, as you might imagine. 80% of the structures were damaged or destroyed. A dozen people were killed, and countless livestock and other animals were killed by this huge, huge flood. One day that summer, my father came to me and he said, "Devin, I'm going to go up to Rexburg with the church group, and I'm going to help dig the muck and mud out of basements. Would you like to come?" Now, I was 11. I thought digging muck and mud sounded like a really good time. I remember I was so excited. We got on the bus, 2 a.m., drove through the night from Salt Lake City, and arrived at dawn. And immediately, well, we had a donut and then went to work. And I remember we worked all day, and it was an amazing experience. I remember thinking that I had really changed the world. I recently returned as an adult to Rexburg and looked all around town. I could not find the statue that they had erected in my honor. I was a little surprised. I couldn't find it. It must be there somewhere. But no, as an adult, I appreciate I didn't really make a difference. The fact is, I was too small to be much help. They gave me the shovel. You can see this is a photo from that day. You can see they gave me a shovel that no one else wanted, and I could barely use. And I was not productive, but I didn't appreciate that at the time. I really felt like I had been part of something, and in fact was a part of something that did make a difference for people. And I vowed that I would never miss an opportunity to serve other people. Now I have. I've missed some opportunities to serve other people, but I have, over time, made helping others the focus of my life, including the way I invest my money. And so that is what we're talking about here today, is how to invest your money for impact. And it's important for you to understand these 6 crowdfund investment types that are common in order for you to be able to invest like a pro. you can't do this casually. It takes real preparation. So let me walk you through a few things. I mentioned already, not investment advice. You can get my book, How to Make Money with Impact Crowdfunding, at 4sc.fund/book. That's 4sc.fund/book. That's a great way to buy my book. But I'm going to share a secret at the end of today's presentation. I hope you'll stick around for the end. I'll tell you how to get a free ebook copy of my book. So please stick around, listen to this presentation. You're going to learn a lot if you stick around. For most of us, ordinary investors, the best investment opportunity we have really is the stock market. Over the long haul, decade after decade, the stock market tends to return an average of about 10%. That has held true for a long, long time. When I was in college many years ago, that's what they taught us. The data still showed consistently over time, long-term stock market tends to return 10%. Now, you only get that if you pay no fees and you invest broadly in the market and don't overtrade and make no mistakes. Most of us make mistakes. Most of us pay some fees. So the reality is it's very difficult to even average 10%. And only luck, honestly, allows ordinary investors to ever beat the stock market average return for any period of time. And it's important to remember that down markets happen. When in the dot-com crash around the year 2000, some of you are too young to remember this, the NASDAQ dropped 80% from top to bottom. In more recent times, in 2007, the stock market peaked, and then 18 months later, it reached its low point, 56.8% lower, as measured by the Standard & Poor's 500. So this stock market can lose a lot of money, say 30% in a year, and it could do that back to back. It could really devastate your portfolio. So the stock market is not a risk-free place to earn money, especially in the short run. Over the long haul, you can invest in bonds. Bonds tend to average over the long haul, again, about a 6% return. In today's interest rate environment, even though we talk about it as high, it's only high relative to recent past. If you're old enough to have a few gray hairs like me, you remember when bond yields were closer to 10%. So that's part of this average. You might more reasonably expect 5% going forward. So what am I saying? I'm saying that stocks and bonds have risks. And if you are investing in the stock market, the bond market, and you're paying fees, and you're making occasional mistakes, the reality is you can probably only expect a return of about 6 or 7% on average, and it's still quite a risky portfolio that you have built. So now let's talk a little bit about impact crowdfunding. Impact crowdfunding is at the intersection of impact investing, a more well-established pattern of investing for impact, mostly with large institutional investors and wealthy families. Now it's open to all of us through investment crowdfunding. Regulated investment crowdfunding changes the game and allows all of us to participate as impact investors through impact crowdfunding. So in this space, we can match the returns that we get in the stock market or the bond market, those public markets where most of us have most of our investment dollars invested. Our 401ks and IRAs, those kinds of things are typically invested primarily in the stock market. Now, let's talk about debt versus equity. These are the two basic types of instruments you can invest in. You can invest in loans. That's sort of like investing in bonds in the bond market. That's a corporate obligation. These are small corporations, small businesses that are issuing debt, and they're asking us to provide the capital for that debt. And The other kind is equity, and that's when you own shares that give you a tiny fraction of ownership in these companies. So those are the two broad types of investments that you can make. We're going to walk you through the details to break that down a little bit more. When we're talking about debt, the primary type here is term loans and revenue-based financing. Those are the first two types of instruments that we're going to talk about today. So let's start with, and then in equity, we'll talk about convertible notes, which is technically a form of debt, but it's really an equity style investment. We'll talk about simple agreements for future equity, we'll talk about preferred stock, and we'll also talk about common stock. These are the four equity types of investments that you'll see commonly in regulated investment crowdfunding. There are other kinds of projects that you'll see out there that have different terms that don't neatly fit into one of these buckets. That's okay. But understanding these six types will help you understand those that vary from them as well. Let's start with term loans. Term loans are really as simple as you might think, right? We're talking about car loans, right? This is the way a car loan works. You go to the bank, you borrow money for 5 years, you pay it back principal and interest every month, and at the end of the car loan, you own the car outright, even if it's now kind of a junker after you've owned it for 5 years and driven it 100,000 miles. It's the same way your mortgage works. Typically, a mortgage is a lot longer, 15, 20, or 30 years, but you make a monthly payment. That payment includes some interest. With a mortgage loan, a lot of interest and a little bit of principal every month until finally you have paid that down over a long period of time. That is a form of a term loan. So when we talk about term loans, this is kind of familiar territory in a way, right? Because most of us have taken out a car loan. Most of us have taken out a mortgage. And so if you are in this mode of wanting to invest, one of the great places to start is investing in term loans. And it's because it's so easy to understand these familiar terms. So you lend someone money. Typically, most often, the companies that are raising this way are using 2 to 5 years, 24 to 60 months. They pay interest rates, usually, not always, but usually between 10 and 16%. So you see, you can match stock market returns with a portfolio of term loans that are easy to understand. That's kind of an interesting idea. You don't have to get super sophisticated. You don't have to take crazy risks. You build a portfolio of term loans and you can get your money back with interest. It's really kind of amazing that this works. Now, here's the reality. The United States has had some challenging economic times, but technically, we haven't had a recession since the 2007, 2008 recession, the Great Recession. So it's been like 15 years since we've technically had a recession. That also means that in the years since crowdfunding began, we haven't had an opportunity to really test to see whether these companies can hold up their payments during a recession. And I can tell you some won't, right? That's why it's important to have a portfolio approach. But these loans typically are fully amortizing. Now, there are some variations. What are we talking about when we talk about variations? Sometimes you'll see a loan that's structured to have no payments at all until the end. Typically, these are shorter, 1 to 2 years, but it could be of any length, right? Where all the money is just paid at the end in the form of debt. So you invest $1 and you get, say, $1 plus interest accrued over 10 years at maybe it's 8 or 10%. You get all of that interest and principal back in one payment at the end. That could happen. You could also see loans where you have annual payments of interest only and then principal at the end, you could see, I mentioned that the interest rates that are common today are 10 to 16%, but you could see interest rates anywhere. The issuers can offer you less, much less, 1%, 2%, 3%. I once invested in a high probability crowdfund investment that paid 1%. And a year later, they gave me back my money. They gave me 101% of my money a year later. Some will pay interest only, quarterly or annually until maturity. And the terms can be any, the length can be any. I've invested in some that are up to 10 years, but there's no rule anywhere that says you couldn't offer 20 years, 30 years, like a mortgage. So, you could see lots of variations out there. But the great thing about term loans is it's not too hard to read and understand the terms before you invest so that you know when to expect your money to come back. Okay, now let's talk about revenue-based financing. This is another form of debt, but it's less predictable because instead of defining exactly when you will get your money back, they define the conditions under which you will get your money back. And that is, they typically say, we'll pay you back a percentage of the revenue. The group of investors who invest will get a percentage of revenue. Usually it's a small percentage, like 1 to 5%, until the loan is paid back with a profit. So typically they'll say, you give us $1, we'll pay you back $2, maybe only $1.50, maybe $3 or $4. It varies, right? So customarily, but not universally, those payments are calculated and made on a quarterly basis. So you start getting payments pretty quickly, but not immediately. But it's based on the sales, right? How much revenue the company is generating. And if the company isn't generating any revenue when you start, you've got to wait for them to generate revenue. That's the reality. Now, I've got a few suggestions to help you think about investing in revenue-based financing notes, which I think are great instruments that should be used more by issuers and investors. But pre-revenue companies, and there's no reason a pre-revenue company can't offer you these deal terms. But a company that isn't generating revenue yet should promise you at least 3 times your money, maybe 4 or more, right? Because you're taking a lot of risk. And you say, well, equity investors get a lot more than 3 or 4 times. Yes, that is true, but you have to wait for additional risky things to happen. You have to wait for some sort of liquidity event. Where a revenue-based financing note, you just have to wait for revenue. So it is a reasonable thing even for startups, but you need to make sure you're getting a proper return, 3 or 4x your investment. Companies that have revenue but aren't profitable yet should probably promise you at least 2 times your money, and pretty quickly, 5, 6, or 7 years at most, right? And then thirdly, profitable companies that can promise to pay you back within, say, 5 years, I think those can maybe get away with promising you 1.5 times. But in those cases, I would suggest to the issuers, you should probably be thinking more about a term loan than a revenue-based financing note. But if you choose this, as an investor, I'd look to get at least 1.5 times. Okay, so that's how revenue-based financing works. There are a couple of things finally for consideration. It is difficult to estimate your exact financial return. So I built a tool that helps you model this, and it's available online for anyone to play with. You can just scan this QR code or visit 4sc.fund/RBF. 4sc.fund/RBF. And that tool will allow you to play around with what the returns might be based on the terms of your particular offering that you're considering. And you can decide whether those terms are good enough for you. Okay, now let's talk about equity investments. We'll start off with with convertible debt. And of course, convertible debt is technically loans, right? But with convertible debt, these are typically early stage companies, often pre-revenue companies. And so the note is intended to provide you with a little bit of downside protection. The reality is a startup usually winds up when all of the assets are gone. So if things don't work, you're still likely to lose all of your money in convertible debt investment. So don't think of them as being safe, but compared to some of the other instruments, they are a little bit safer than say a common equity investment, even a preferred equity investment, and certainly more safe than a safe. And we'll talk about a safe in a minute. The convertible debt is really intended as a way of organizing money until it is converted into equity. It is not intended as an instrument that is paid back. It's very rare that people will plan to pay back their investors with cash. It rarely happens, does happen, but generally speaking, the money is converted into an equity investment. And it may convert into common shares or preferred shares. We'll talk about the difference in a few minutes, but just keep in mind that that is an important distinction. So you need to understand when you invest in convertible debt, whether you are converting into common or preferred. That's a very key thing. And oftentimes it isn't prominently displayed or apparent. And then finally, it's important to note that your approach should be thinking about appreciation, not interest rates, not, there isn't a simple calculator that I can prepare that would help you think through this, like with the RBF loans. This is very different. You should be thinking about, I put in $100 and I want to get at least 1,000 back. And you say, wow, that's a lot. Why? And the reason is there is so much risk. It is so likely that you will get zero back that you need to be confident that if the company succeeds, you can get at least $1,000 back and maybe $10,000 back. I know that sounds crazy, 100-fold return. But when you are investing in a very early stage business, there is a lot of risk. And so experienced investors generally want to get 10 to 100 times their investment on the back end. So be thinking about that as you look at the deal terms of a convertible note instrument. So the fourth type of agreement, the fourth type of investment instrument that you'll see in regulated investment crowdfunding is simple agreements for future equity. And when we talk about that, they're called safes. And there's some irony in the word safe because it sounds like these are safe investments, and they're not. This is a very it's intended to be a fairly simple equity investment instrument, but you're not getting shares of stock. You're just getting a promise to give you shares of stock in the future if certain conditions are met. Because these agreements are simple-ish, again, that's kind of in the eye of the beholder, but because they are kind of simple and low cost to organize, they are certainly founder friendly. That is, it's a kind way to invest in founders because you're not forcing them to spend a lot of money on attorneys and technical things before they're focused on the business, right? You want an entrepreneur really focusing on the business they're building and not on the legal issues of running a business until they really get off the ground and start having some success. So it is a great way to support a founder. On the other hand, there are some founders, issuers in the crowdfunding space who are using them a little bit inappropriately, right? A typical trigger for converting your SAFE agreements into equity is raising a lot more money. That's the standard one, usually $1 to $5 or sometimes even $10 million from institutional or large accredited investors. Well, if you are running a small restaurant in a small community, you're probably never going to raise a lot of money. You shouldn't be using a SAFE to raise money now because you'll never do the things that would trigger the conversion to real equity. And if you haven't converted, it's a little bit unclear what the claim of the investors is. So when you invest in a SAFE, make sure that you are comfortable that the company has the potential to go on and meet all of the triggers in this SAFE agreement so that you understand whether or not that's likely, right? Small sandwich shop, lunch counter in a small town, probably not going to raise $10 million in Silicon Valley. Probably not. Maybe with a franchise model, it's possible. Not likely, but possible. So, be aware of these things so that you don't get caught holding a SAFE in a company perpetually that never converts into equity and never pays you back. Okay. The fifth type of investment on our list of 6 is preferred stock. And this is what venture capitalists almost always want to invest in. Venture capitalists are professional investors. We think of them oftentimes as being very wealthy people, and most are quite affluent, but generally speaking, they're managing other people's money. So they are professionals in the literal sense of that. They're being paid to manage funds on behalf of others. And this is how they like to invest, is in preferred stock. It is investor friendly. And I'll show you a little bit of just how dramatic that investor friendliness is in just a minute. But it is profoundly investor friendly. And so when you are looking at investments, you should be aware that this type of investment has the potential to hurt the founders. And that may be fair if you are a school teacher investing $100 in a guy who just earned an MBA at Harvard after finishing his undergraduate degree at Dartmouth, right? And comes from a family of money, and you are investing in his success, right? Well, you probably shouldn't feel bad at all about having investor-friendly terms in that deal, right? As a school teacher in the Midwest who's trying to invest for profit, right? That makes all the sense in the world. Even if he's running a social enterprise, it's going to make a real difference in the world. On the other hand, if you are a wealthy Silicon Valley investor investing in someone who is an underrepresented founder in a challenging economic environment, this isn't a very kind way to invest. So be aware of that. The preferred stock occasionally accrues a dividend, not always, but it's never intended. It's unusual in small businesses and startups for that preferred stock to be to generate a cash flow. It's intended to accrue a greater claim on a payout in the future. Excuse me. So don't expect cash from this until there's a liquidity event. But let me show you what happens when a liquidity event happens if the liquidity event isn't great for the founders. So this table is kind of busy, but let's walk through this for a minute and make sure that you understand how investor friendly preferred stock really is. Let's say that all the investors invest in preferred stock, and maybe that happens by virtue of converting notes or safes into preferred stock. But let's say eventually everyone that has invested $10 million, and it's all held as preferred stock. Okay, customarily, the founders don't own preferred stock, they own common stock. That's kind of the whole point, right? Is that the investors get a claim that comes ahead of, is preferred over the common shareholders who are taking more risk. Okay, so let's say that nominally that $10 million represents 20% of the ownership. That would imply a valuation for the business of $50 million, right? So that's as a starting point. So the investors in this scenario are really hoping that that enterprise comes to be worth $500 million someday, or $1 billion, or $5 billion, so that they get that 10x or 100x return, right? But something's gone wrong in these scenarios. I'm just showing you the downside scenario, how preferred stock works. Let's say you sell the business for $1 million. The proceeds to the investors are $1 million. The investors take all of the money. Now they've lost 90% of their investment, but they take all the money, and the founders, who presumably did draw salaries, get nothing. So they get no payout. Okay, now let's assume that the business sells for $9 million. A lot more money. In that situation, all $9 million still goes to the preferred shareholders, those investors. Okay, and the founders still get zero. Okay, let's assume that it sells for $12 million. So that's more than the investors invested. The proceeds to the investors, they will get at least $10 million. And if there is a dividend that's accruing on that preferred stock, they still may take all $12 million. And the founders will get something less than $2 million in that scenario. So you can see that really before the founders start to participate, you'd probably have to sell this business for at least $12 million, maybe $15 million, and then they would just get a tiny fraction of the payout. So preferred stock really and truly is a very investor-friendly structure. Common stock. Now, common stock is the kind of stock that generally, preferred stock trades on the stock market a little bit. It's a little bit tricky to find those preferred shares, but they're there. Common shares are what we generally talk about. So if people say they own shares of Tesla, they're talking about common shares of Tesla or Google or Apple. Those are common shares. So it's not a crazy thing to invest in common shares. That's a fairly routine thing in the stock market. So that is kind of the normal thing. And it puts founders and investors on equal footing. So this is a way of sort of equalizing things. So it's relatively founder friendly to invest in common stock. And there may be times when it makes sense for you to say, I'm going to be generous and kind. I'll take the risk right along with the investors. We are similarly situated. But it's important to note that VCs and angels, professional investors, active investors, rarely invest in common stock. So it's worth thinking about a little bit from an investor standpoint to be a little bit cautious about investing in common stock because of these extra risks. Now, I want to be clear that there is a lot more to learn before you are prepared to be truly and genuinely able to invest like a professional. There's a lot to learn about investment strategies, and at a future SuperCrowdHour, we'll talk about investment strategies that build on the understanding around these 6 investment types. It's vitally important to understand due diligence. Got to understand how to do research on these companies to understand the risks that each one represents and to begin thinking about building a portfolio that is diverse. Think about how your crowdfunding investments fit into your overall investment. If you own a home and you still have some money invested in the stock market, you would use, maybe a little bit in this area. So there's so much to learn, so much to talk about. I want to be clear, the understanding these 6 investment types we've talked about today is vital. You really can't invest like a pro without some of this understanding, but it isn't sufficient. I have, and I'll just share this now. We'll talk about due diligence at a future SuperCrowdHour, but this AI due diligence tool that I've created helps you accelerate your due diligence on a crowdfunding investment. And you can get this tool at 4sc.fund/AIDD. Think of that as AI, artificial intelligence, due diligence, AIDD. So 4sc.fund/AIDD. And that's a tool that will help you do your due diligence more quickly. Now, I like to highlight the fact that you can get started with $10 because it's so important to learn by doing. I want to encourage you to go do it today. Visit the SMBX. It's at thesmbx.com or Climatize. So that's climatize.earth for their websites. Visit those websites, and on either one, there are investment opportunities where you can invest just $10. And you can begin to experience this, begin to learn how it works operationally with a tiny amount of money that virtually anyone can afford to lose, and begin to see what's going on. SMBX offers only term loans that they underwrite carefully, and so that's a little lower risk. The Climatize is a very earth-friendly, as the name implies. So if you're interested in saving the planet, that's a great place to go invest your first $10. And you can begin learning. And the Climatize deals tend to be very different in structure, and they're complicated. But at the same time, starting with $10 is a great way to start learning. Okay, I promised that I would tell you how to get the book for free, How to Make Money with Impact Crowdfunding. Get your ebook free at 4sc.fund/ebook free, or just scan this QR code. And so with that, I'm going to jump to Q&A, and I'm happy to take your questions now. So whether you're watching on television, YouTube, Facebook, Instagram, wherever you are, you can ask some questions, and we would love to hear from you. So Oppie Potter asks, for someone with limited funds, which investment type would you recommend starting with? I think that's a great question. And I think, it would depend on the circumstances. So I want to be careful not to make this too broad a brush. But starting with term loans has some advantages because, and there are 2 or 3. First off, starting with term loans, They're easier to understand. It's easier to understand the risks, right? Because you can, as a fairly new investor, you can begin looking at a company and say, do I think these people know enough about their business to run it well? Have they been profitable in the past? That's an easy question to ask and answer. If they've been profitable, they have a much better chance of paying me back, like they're promising to do. And so it's relatively easy to understand. And then it also has the advantage of the money comes back pretty quickly. If you invest in a 2 or 3 year loan with interest at 10 or 12%, wow, you can get all your money back with interest, complete at full circle, 2 to 3 years. That's pretty great. That's pretty great. So you can learn a lot without a whole lot of risk in the term loan space, right? Now, I want to caution, don't put a lot of money into one deal. I really like the idea of starting with $10 at SMBX. If you're pretty affluent, if you've got that 6-figure income and a nice car, it's not crazy to start with $100. That gives you a lot more options about the sites you could explore, Honeycomb Credit, and others that offer term loans. But be careful to start. Start small. Okay, great question, Oppie. Thank you very, very much for that great question. Chandon, let's see. Chandon, have you got any other questions for me? Let's see. Gail asked, which investment type is the best? Of course, it all depends on the circumstances you're in. And if you are really young and you've got a great job and you've got a lot of money already saved for retirement, boy, you're in a good shape. I'm jealous. Congratulations. You may want to use your crowdfund investments to invest in equity type investments where you have that 1 in 100 shot of getting 100-fold return. Build a portfolio of those opportunities. Scrutinize the team, scrutinize the technology, understand the risks, but begin looking at those opportunities. And it may be SAFE's preferred, common, or otherwise, the convertible notes, whatever instrument, but just make sure you understand the deal terms, understand the valuation. My gosh, the valuation is so important. We'll talk about that at another webinar. But it depends kind of on your circumstance. As you get closer to retirement, those short-term notes that are paying 10 or 15%, boy, those are pretty tempting as you get close to retirement. Increasing the yield on your portfolio is really helpful. At some point, you're gonna have to start spending some of the money. So having cash flow from your investments becomes really sort of paramount if you are going to be spending some of your investment returns. So it kind of depends on your circumstances, Gail. Well, that's a great question. Chandon, are there any other questions? There I see a question from Oppie. What resources do you recommend for staying updated on the latest crowdfunding opportunities? Well, that's a great one. Of course, it's a little self-serving because I like to think that my colleague Chandon and I do a better job than anyone in the marketplace in terms of sharing impact crowdfunding opportunities. There really isn't anyone else doing what we do, sharing the new list of offerings every week and making them accessible to potential investors. So you can get our list at superpowersforgood.com, and you can sign up for our newsletter or just check it out and see our recent lists. King's Crowd, here's another resource. King's Crowd is a great resource that offers people an opportunity to invest. You can see all of the current offerings at kingscrowd.com. You can and it's no fee. Don't even need to sign in to start searching for investment opportunities. Now, KingsCrowd also offers due diligence and a variety of other services. You can get a free portfolio builder if you set up an account at KingsCrowd. I've done that. You can also buy their research reports if you're going to be investing significant amounts of money, and that's for you to decide. I think it's imperative to get some research from people like KingsCrowd. I would encourage you to do that. So, Hoppy, great question, but I certainly think those are a couple of great resources. It's too time consuming, in contrast, to be spending your time looking at the portals, browsing around if you have a broad appetite or broad interest or a narrow one, right? If you're looking specifically for opportunities to invest geographically near you, just looking at one portal is going to be frustrating because that will only give you a glimpse into the total marketplace. Okay. Gail's asked another question. Let me answer her question. This came in via email, but her question was, could you explain how revenue-based financing notes work? Yeah. These are those notes that we were talking about before, the second investment type we mentioned. And these are loans where the company, the business, promises to pay a percentage of revenue, usually 1 to 5% to investors. And the promise is usually pretty simple, right? You give us $1, we give you $2 over time as a percentage of our revenue. Now, it's important to get into the weeds before you invest in one and understand what happens if, for instance, the time runs out and they haven't made all of the payments. Does the balance become due, or is the balance forgiven at that point? There are a few other things to check, but really, these are remarkably simple agreements in that they promise simply to pay to the group of investors a percentage of revenue that results in an outcome equal to a multiple of your initial investment. And there's a time frame. It provides a limit. I would always want to make sure that at the end of that time frame, they are obligated to pay you the balance. If they have built a successful business, even if they don't have the cash on hand, they should be able to refinance it by going to a bank or someone else to borrow the money to pay back what is due. So they're great investments in that you can even make these in startups and effectively reduce your risk and still get portfolio returns that compete with certainly the stock market and maybe even professional investors who are investing in venture capital, right? Because if you're getting 3 or 4 times your money in 7 to 10 years, that's a great return that would beat the performance of most investors. So I think it's a very reasonable part of your portfolio, regardless of whether you are kind of biased toward startups with great potential or whether you like small businesses that can just pay you back. This is a nice happy medium spot for a lot of deals. So great question, Gail. Thank you for that. Let's see, Chandan, I don't see any more questions coming in. So I want to thank you for your help today, Chandan. I want to thank everyone who came and participated today. I think this has been a good discussion. I hope you feel like you've learned a lot. I look forward to engaging with you in the future and hope you will subscribe to our newsletter at superpowersforgood.com. And we'll look forward to seeing you in the future. So thanks very much for being with us today.